Two major stock splits took place last week for Amazon and Tesla. Here's the key takeaways. So, Amazon completed a 20-for-1 stock split on Monday, and on Friday, Tesla proposed a 3-for-1 split. Shareholders will vote on the move at the next company annual meeting in August. Stock splits are all the rage these days. For example, Alphabet will split 20-for-1 on July 1st. Shopify will split 10-for-1 on June 29. So, what happens? Well, it's pretty simple. Let's say you own 100 shares of a $1,000 stock that splits 10-for-1. After the split, the market price of the stock drops to $100. However, you'll now own 1,000 shares of the stock. Therefore, the value of your position, $100,000, doesn't change. But there is a downside, and this comes down to investor perception. You have to ask what a company's main motivation to split is, but also you have to look at how the media reports these events. Stock splits do not mean that a stock is getting cheaper. It does, however, make it more affordable, and that's a key difference. From a valuation perspective, nothing changes. All a stock split does is increase the number of a company's outstanding shares and decrease the market value of each share. However, from a psychological standpoint, stock splits can have a real impact. Tesla shares will feel less expensive and more financially accessible to many everyday investors at, say, $233 rather than $700 per share after a 3-for-1 split. This is the main reason why companies split their stock, to attract retail investors. And how do stocks perform after splits? Well, compared to the broad market, stocks that split underperform in the near term and fail to meaningfully outperform over the long term. There's no significant difference between more common 2-for-1 splits and these recent 10 or 20-for-1 splits. There's no conclusive data on stock price action after an announcement such as Tesla's and when the actual split occurs versus the aftermath of a split. The bottom line is this. Trying to benefit from a stock split, whether you buy before or after the actual split, amounts to timing the market. You'll win some, you'll lose some, but it's not a sound long-term strategy. You're better off buying Tesla, or any other stock for that matter, on the basis of your conviction, not the cosmetics of the stock's market price, particularly in an investing environment where you can purchase fractional, less than one whole share, shares of a stock. Your fractional position size could grow to greater than one share post-split. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.